Hey folks, welcome back to episode 8 of ICT 2024 Mentorship. So this is a long video, near about 4 hour 20 minutes video. I will try to explain my understanding over here the way I have explained all other episodes before. It's gonna be a lot of information. I don't know if you will be able to digest all of them by after watching one time or not. At the same time, I'll try to make this video as small as I can. Okay, but I'm not going to promise that. Don't be scared after seeing the length of this video. Before going to this video, I would love to request you, don't forget to give me the thumbs up and subscribe to my channel if you are new, as I'm doing a hard job, man. This is midnight in Bangladesh and I have just finished ICT's 4 hour video notes and then started to record this video. So I hope that you will appreciate my hard work and you will give me the thumbs up with free of cost. This is the CPI candle around 8:30. So around 8:30, market has taken all of this liquidity. So it has went higher, took all of this liquidity. It went lower, took all of this liquidity. There is a wick. The 50% of that wick is important. So what you have to do, you have to mark the 50% of that wick. As per ICT, whenever you will get a wick in a swing high or swing low, that wick 50% is always important. So make sure that always you have marked the 50% of that wick. So I'm going to mark the 50% of that specific wick over here. Just keep that in your mind. This is the 50% of that specific wick. Now when I have marked that specific wick 50% and market went higher above this market, I have this new wick opening gap. 28th of July, market has made that new wick opening gap. I will go step by step. I'm not going according to ICT's video, so I will start from there and I will finish over there. Okay. Now, when market started to go higher, look at this candle. I mean, this candle which has made this inefficiency around that area. So I'm going to mark that inefficiency over here. If you are thinking that market is going higher, why you will think like that way? Because market went lower. This is the weak 50%. Market failed to trade that area. Then it started to go higher. When it started to go higher, look at this fair value gap. To that specific fair value gap, it will trade that fair value gap. Then it will go higher where it is reaching for that new weak opening gap. Because this is that imbalance. Market should reach over there. Yesterday, that was ICT's expectation that market will reach over there to that specific new weak opening gap. As market didn't reach over there, so today he is expecting first market will reach over that inefficiency. If you have watched all other episodes like from 1 to 6, you will understand what is the importance of new week opening gap and the new day opening gap. Today around 5 p.m. or not today actually, yesterday Tuesday 5 p.m. and 6 p.m. close and opening, there is no gap. So I have marked that opening price around 6 p.m. This is that line. You see the dotted line. As there is no new opening gap, I have just marked that opening price because market is going to refer that price again and again and again. Okay. So when market trade that fair value gap, you can see there is a mohawk. That means market went through this fair value gap little below of that fair value gap. Why it did that? So I would love to zoom over here to explain this part now. Now this week, look at that week. Okay, this is very small week from this week low to until that this candle high. This is the balanced price range. When market started to fall, it stopped over that specific balanced price range to tell that no, you are not allowed to fall more. This balanced price range stopped the price and went higher. ICT told that he is not going to reveal this, why this mohawk is going to happen over there. We will get that in his book. So I am not also going into the deeper over here because I don't know as ICT didn't explain. Below this gap there is another fair value gap. So this candle high and this candle low, you can see that there is another fair value gap. Now as ICT told that you should mark that fair value gap from there. This candle low, look at this candle. Okay, this candle low, sorry, not that candle, this candle high and that candle high. Okay, so here that candle high and that candle high. So exactly from that balanced price range area to until that high, this is actually your fair value gap. You don't need to focus over here as per me, because ICT just explained that, but he didn't explain elaborately. Maybe we will get this information in his book, so you don't need to focus over here right now. But all you know that your fair value gap is over here, this candle low, that candle high, this is your fair value gap. As you don't have the volume balance, so you can just mark it from there to there. If there is a volume balance, then you will mark until the volume balance high. So I'm going to remove this fair value gap, and I would love to talk about this price action. So market came here, trade that fair value gap, it went higher. When it went higher, how far it can reach? Here is another thing. See this wick when around 8:30 market first made that wick high. You will mark the 50% of that wick. Okay, so here this is the wick 50% here. Now when this wick 50% has been violated by that wick, okay, so if you just mark from here to here, this is the 50%. Okay, that wick high, this candle close, that 50%, this is that line. Let me just mark that line around that area. This is all the information you are learning. Okay, you are not going to implement them as ICT explained this, so I am just making that sure so that you have, if you have any confusion, that will be clear over there. This week 50%, which was around that area, so you should expect that the next candle will trade until the 50%, then it will fall for to eject the sell side liquidity, because market has taken the buy side liquidity by the news candle, then it will take the sell side liquidity. As it didn't do that, instead it went higher. You will see the algorithmic price run over there. See this candle wick is actually this candle. Okay, this wick, how far it has reached? Double of that wick. So from here to here, it went double of that wick. See, so here to here, this is the double. So when you see this type of situation, you will think that market is actually preserving that high until the opening bell. So after the opening bell, market is actually going to take that high, and it will reach in a certain level where you were expecting at your beginning. So you will expect market will reach over there after the opening bell. This is how ICT actually predetermine then which high or which low is going to be preserved until the opening gap. This is how he preserved it. As market make that things algorithmic run exactly tick by tick, double of that range. Here this is the double of that range. That means when this range has created, it didn't trade that new week opening gap, which is your target. Market should reach over there. It didn't do that. Instead it went lower. Market is not going to take that high until the opening bell. So after 9:30, then market will reach over there. If you see, this is the opening candle around 9:30, opening bell, then the 9:31 candle reach over there to that specific new week opening gap. Okay, this part is done. Now I would love to explain here when market has traded that fair value gap perfectly. It has traded that fair value gap, went higher. When it went higher, look at this candle. What is that? Down close candle, which is your order block. Mark that order block over there. So from there to there, this is your order block. Turn it to your right, and let me change the color. So this is the order block range. What happened? Market trade here, where? To that specific order block. 2 times, maybe this is the 3rd time. It has traded that, then boom, where did market reach? To that specific new week opening gap. I would love to talk about the turtle soup over here. Some of people actually think that turtle soup will take the old highs or old lows, then it will reverse. No, it's not right actually, because if you would love to use the turtle soup, then there is a lot of things should be implemented all together. I'm not going in deep over there. All I would love to say that if you think about the turtle soup, then just don't think that market will take some kind of old high and then it will reverse. It's not like that. Okay, there obviously there must be some other elements as well. For example, here we have the new week opening gap. We have all of these highs at the same time, that old high, everything went higher. this change in state of delivery hold the price, send the price over there. So when it sends the price over there, this two up close body close candle is going to be your order block. That is your bearish order block. Where exactly from that open. Okay, so that is your change in state of delivery. Why it is change in state of delivery? Because from yesterday, you know that market was going higher. Okay, from Tuesday morning session, market was going higher, higher, higher. Then finally, this is the last run. This is the last run where market reached until a certain level. What is that level? New week opening gap. It went over there, so it is a buy side. Okay, it's not. It's clearly a buy side delivery. Then when market went lower, closed below this open, that is changing the state of delivery. That was a buy side delivery. Now it is going to be a sell side delivery. When it is a sell side delivery, here is your imbalance. So let me mark that imbalance over there. This is your imbalance. You should think that market will tap to this fair value gap. Now, in open eyes, it seems like that market has traded that fair value gap, but it didn't trade that just for little. Okay, just for little. Market didn't trade that fair value gap. Why it didn't trade that fair value gap? Because this order block and the mean threshold, the 50% of that order block. Look over here. It has traded that mean threshold of that order block. This order block was holding the price, then sent the price higher until that certain level, then market went lower. Okay, I would love to mark it until that area, this order block level. Okay, just remember this is the whole box is the order block. Then market went lower, closed below the mean threshold. That is the 50% of that candle. The best option is when market actually closed below this order block, then it is the best option to think that this order block is going to be broken. So when I just don't need it anymore, because you have seen that market has already closed below that mean threshold. Then market actually went lower, went higher again, tap to this opening of that consecutive order block. At the same time, here you have the breaker block around that area. So this breaker block and the order block, both of them are holding the price, and market was extremely bearish. It didn't even tap over there to this fair value gap. Instead, tapping over there, market was keep falling. If ICT missed that entry, maybe he just put a limit order tick by tick at the top of this candle. See this candle high. He put a limit order over there. He won't be filled. Okay, market didn't take him with the run. What ICT do in this type of situation? He has seen that market has taken all of these highs, trade that new week opening gap, went lower, go below this swing low. Look at this swing low. That is your market structure shift. There is his fair value gap, and he was expecting that market will trade that fair value gap. Then it will reach to the 50% of that week. Okay, every swing high or swing low, if there is a week, the 50% of that week is extremely important. So his primary target is that week 50%, and then the week low, that is the last. Also he has marked the quadrant level, but as it was not important and he didn't actually show anything from that quadrant, I'm just not going to mark that quadrant. Instead, I would love to mark that low as my sell side liquidity. Okay, so until that week low, he was expecting that market will fall. If he missed that entry over there, he is not going to chase the price. He is not going to get hurt. Oh man, I missed that trade. No, something not like that. Most of us actually do that and we lose a lot of money. We blow a lot of accounts. So we should not do that. Instead, we should think that if I miss it, we will just read the price action and we will see how it delivered the way I was expecting. Then when market failed to trade that fair value gap, why it has failed to trade that fair value gap? Because market has traded that, look, this order block open, also this breaker block over there. This has been traded over there. Then market fall dramatically. When it was falling, how far it has reached to that specific line? Is it random? Look over here. So this is the 50% of that specific week. Market tapped until this 50% of that week, then it went higher. Where did it go exactly? Look at this imbalance. So I would love to mark that imbalance as well. So over here, this is the imbalance. Market has traded that imbalance. Let me change the color and make it Okay, so it has traded that imbalance. Okay, now come over here. So far you have learned that if there is a week in a swing high or swing low, that week 50% is important. So I'm going to mark the 50% of that week. Okay, so this week 50% is important. So I would love to mark a line over there so that you can see it, and there is the line. Okay, this is the week 50% to that specific week. Okay, this is when market went higher, it has closed this fair value gap. This fair value gap has closed by that week perfectly. When market has closed that fair value gap by that week, it went lower, come back again. Where did it came? Exactly to that 50% of that week. This is ICT has shown this to show you the algorithmic price run. You should expect this type of things, that the market is not going to trade that fair value gaps, constant encroachment. If it failed to trade that constant encroachment, it should keep falling after trading that. Then why market reach until that area? What was the reason for trading that area? The first reason is here. This is that line. Remember the new day opening gap? We don't have that on. I just marked that line. That line is at the level of this fair value gap, constant encroachment. It has traded that line. It traded until this week low, closed that fair value gap perfectly. Then the very next candle, it has traded that week 50%, tick by tick. At the same time, where did it has traded? This week 50%. Okay, so this is the week 50%. So just let me make it a little bigger. This is the week 50%. If it wants to trade that 50%, it is also cool. But as market has got that week 50%, it didn't reach until this week 50%. So it is good sign that market is extremely heavy, market is falling. So this week 50% even failed to trade that 50%. You should look for this type of things, that market is extremely heavy and it's not willing to trade even the 50% of the premium zone. So this is your premium zone. What else do you have? Remember that fair value gap? That fair value gap is now working as the inversion fair value gap. Okay, so this is the inversion fair value gap. Let me just change the color to here. Okay, this is now your inversion fair value gap. This week has traded until that inversion fair value gap, constant encroachment over there to that week low exactly. If you are thinking that market is going to fall, what should you think? That this inversion fair value gap upper portion, the upper 50% should be open just a little bit. Even if it is one tick open, that is cool, but it has to be open. It has to left that inversion fair value gap open, upper portion open. If you see that there is a upper portion open and then market is falling, you should believe that market is actually reaching for some kind of certain level where what is actually more obvious. And it can be that this week low, or there should be some kind of standard deviation. ICT has told that standard deviation as well. I will show that after a little, but until that level market is going to fall. How do I know? How do you know that? Because this inversion fair value gap, see this fair value gap, this inversion fair value gap upper portion market left open, it reached until that line, until the exactly to that low. The same thing over here. Remember this thing, this week has perfectly closed this fair value gap. Here this thing is going to repeat. It has closed this fair value gap perfectly, this week high to that week high, here to here. This area is balanced. So when market tapped over there, this balanced price range is telling that no, you are good, you are stop, you should stop over there, you should fall now, you don't need to go higher anymore. What else? Over there I have already explained all of these lines, and I hope that you got the premises over here. You have this bearish fair value gap, you have that weak 50%, you have even this inversion fair value gap, new day opening gap. You don't have the new day opening gap, but you have that line around 5 p.m. close or 6 p.m. open. This is that line, the price line. Okay, because there is no gap. You have lot of things over there, and you are thinking that market is reaching for this low because market has already traded that 50%. Say this 50% of that specific week. Look at the reaction. You are going to think that market is going to take that sell side liquidity. Now, for example, you don't have this fair value gap, you don't have that fair value gap, you don't have this week, look at this week, you don't have that week, then what should you look for in your in your back? When market made this market structure shift, order block, breaker block entry, whatever it is, then market fall dramatically, went until this consonant crossment. Now it is reaching some area, some certain area, then you are thinking that market is going to fall. What area you should look for? Look on your left. Think there is no parallel gap as well. Okay, no parallel gap at all over there. Look at this week. Look, can you see this week? You will mark the 50% of that week, and you will think that market is reaching for that 50% of that specific week. If you don't have this parallel gap, that parallel gap, maybe you don't have this week as well, then you should look for that week, because this week 50% is extremely important. So market has traded that area to that specific fair value gap. It has closed, the first candle has closed that specific fair value gap. The very next candle, which has traded that exact 50% of that week, exact tick by tick, the 50% of that week. Just let me mark that 50% actually. So here, after trading that week 50%, market fall. How did it fall? Went below this low. See this week low, it went below that low. When it went below that low, this is your order block, the change in state of delivery. Okay, so if you just mark the 50% of that change in state of delivery, so I would love to mark from here to here, and this is my sorry, not that one, my mistake. This is the change in state of delivery, so let me mark it here to here. Okay, so there, where market reach until the mean threshold of that order block. What else do you have this week? Mark the 50% of that specific week. So from there to there, okay, you will see the perfection, brother. This is the area where you will start to believe that this market is absolutely and perfectly algorithmic. This is a little deeper price action, which ICT told us that this is little deeper price action, and over here this is the week 50%. Remember that week 50%, this is that line, this is that line. So it has traded that order block. Over here the opening of that candle is the order block. It traded that open, the 50% of that order block. This is the order block. The 50% is the mean threshold. You should not think that market is going to close above that mean threshold. Then market went higher. What did it reach? To that constant crossment, that week 50%. It has traded that week 50%. What the body has closed exactly? See this week, that week 50%. Body has closed exactly to that 50% and perfectly closed over there. Then boom, market fall. Made another fair value gap over here. What should you expect over there? That market is not going to close this fair value gap. So it will, even if it failed to reach until this constant crossment, so let me change the color. If it even failed to reach until that constant crossment of that fair value gap, that is a green signal for us that market is actually going to fall. That is the green signal, because market is extremely heavy. Over here, market is extremely heavy. That's why it even didn't trade until the high of this fair value gap, or it left the upper portion open perfectly. Look at this. This candle tried to reach until this constant crossment, failed. The very next candle tried one more time to trade this fair value gap, failed, and then boom, dramatically market fall. And to that sell side liquidity, if you look at the standard deviation from that high to this low, so I would love to mark that area. So from there to there, okay, and I would love to use my standard deviation. What is the most important low hang? Oh, sorry, not from there actually. From the change in state of delivery, that means from there. Okay, so the order block open. So from there to that area, you should look for the 50%. So that is minus 0.5%. Until that is the low hanging fruit. It can reach until that area, that low hanging fruit. That is the low hanging fruit. You can just expect that market will reach at least until that level. Okay, so it is also important, if you think that their ICT also shows some upper quadrant, lower quadrant to mark the standard deviation, and I don't think so it's really that much important from this video. The most important part from this video is the week 50%. So every week you will see and you will mark the 50% of that week That is the most important part in this video. If you can understand that part, simply these things, this logic, your trading is going to be very much improved. Okay, you will be improved by reading the price action. Now here I would love to talk about the entry as well. For example, you didn't take entry over here, so you were waiting to take an entry over here. I'm going to remove this line, the 50% of that week, and the opening, the opening line from 5 p.m. 6 p.m. close. Here I'm just going to remove that one. So you were looking for the entry over here. Where should be your entry? And let me actually remove this fair value gap as well. Where should be your entry? Look, when market tap to the high of this candle, that should be your entry. Okay, so let me actually write it down, entry. So entry here, entry, that should be your entry. Where should be your stop loss? Look at this candle. So this week low to this week high, this is your fair value gap. Look at that candle. This candle has made this fair value gap. So above that candle high should be your stop loss. So let me just mark it as a stop loss. STOPLO stop loss. So that should be your stop loss. Okay. Now, if you want more precision, where else you can put your stop loss? See this week, that week 50%. Okay. So over here, this week 50% should be your stop loss. So if I just put it over there, that should be your most precise stop loss. If sometimes you see that ICT actually put his stop loss very tight or something like that, this is how he actually, not exactly to that 50%, just little above of that 50%. Okay, maybe 2 tick above that 50% of that specific candle, he is going to put his stop loss over there, and he is going to believe that market is not reaching over there, even it is not going to trade the whole gap. So this gap, okay, so if you see that this low, this is the fair value gap, high, this is the fair value gap, low, market tap to this high, so this fair value gap is absolutely closed. If it is closed, perfectly closed, where is market, ICT is going to trade? He will wait, he's not going to push his button over there. Then the very next candle opened, it didn't reach until that area, or maybe it didn't go above this high. Whatever it has done, he will wait until that candle. The very next candle will open, trade that candle. Look at this candle, it will trade that candle. That is going to be his entry point. So over here, he is going to take his entry around that area. This is how he is actually going to filter his trade to get a better opportunity to trade. And I believe that it is also important for us, this all information, what you will do, you will start to look for this week 50%, and you will start to do the journal. And if you can see the precision, even if you see, sometimes I do my trade myself, I'm talking about myself, I do my trade with quiet. I keep quiet, and I just keep marking some kind of week 50%. So I had an idea that week 50% is extremely important. By watching this video, I have got more confirmation that yeah, I have to mark the week 50%. Every week 50% is extremely important. That week should be a swing low or swing high. Okay, so this week, that week, then this week, over here, this week, that week, all of them are going to be very important. And this is how you will observe the week 50%, and you will start to build your confidence to use the 50% as a reference point. I hope guys you got something from this video, because this is all I got from ICT's video. Though I skipped some information which I thought that it is I don't, in my opinion, that is not that much important at this level, so I just skip those information. And obviously all of the advices ICT has given in this video, I have skipped all of them. I just try to keep only the information that was important and was related with the chart. So until the next video, cheers.